Well, so hi everyone. Nice to see many of you again. For those of you whom I haven't met yet, my name is Travis Pantine. I'm the director of the Insurance Law Center at the University of Connecticut Law School. And I had the pleasure of co-hosting this workshop again with my colleague, Peter Siegelman, to whom I'm grateful for starting this thing 3 years ago. Anyway, it's a great thing. I'm glad that we're continuing it. The goal of this workshop is to provide a kind of intellectual meeting place for people who are interested in insurance law and to take advantage of the newfound comfort with remote workshops and things, and thereby to really create a kind of boundaryless community of folks with this shared interest. We've got a really exciting lineup of speakers planned for this semester. They come from all different perspectives and methodologies, and I think we're all going to learn a lot from them. Robin, whom Peter will introduce, is the first of many. So some just quick notes as to format. So this year, this semester, we'll be hosting this workshop every other week, which differs from last semester, it was every week. However, we will be continuing the every other week schedule into the spring. So if you're beginning to put together your spring semester, I hope you'll block out this same time of the week in the spring and save it for us. Each session in the workshop will be approximately an hour long, sometimes a little bit longer if the speaker is willing to stick around and answer a few more questions. We'll have about 30 minutes of presentation from the speaker, followed by roughly 30 minutes of Q&A from the audience. Peter and I will often ask the first question or two, and then he and I will keep a queue. So if you'd like to be on the queue, feel free to send us a note in the chat or to use the hand raise function in WebEx. The attendees are a mix of practitioners, law professors, other academics, and students, some of whom are taking this class for credit, and we're going to make an effort to make their voices heard and encourage them to ask questions, because it's nice to have a diversity of perspectives from people at different points in their careers. The class or the workshop will be recorded, and the recordings will be posted on our website, as have the ones in the past. If you know of other folks who would like to join this workshop too, please invite them. The benefit of being in cyberspace is that we don't run out of room, so the more the merrier. If you have problems with WebEx, which is not the most common tool to do this kind of thing, I encourage you to try downloading the app on your computer rather than using it through a browser. And you can change the view mode to single presenter so it doesn't look like the kind of Brady Bunch, and that can make it easier to see the shared screen sometimes. And finally, I'd just like to thank the folks who have made this possible, including Jean LeBlanc, Molly Sullivan, Michael Len, and Brooks, who's helping us today. I'm sure I've left out some stuff, so I'll hand it over to Peter.
Great. Thank you. And everyone should please mute. I hear a bunch of background. Does anybody hear that background noise? That's me. All right. So it's a real pleasure to welcome Robin Pearson as the first speaker in our series for this fall. He joins us literally from the University of Hull in the UK, where he is a professor in the School of Business, a professor of economic history. And he has written very widely and very deeply on a whole range of topics in the history of insurance as a business, including a very important article on the role of insurance in the slave trade, a book on the history of fire insurance in 18th and 19th century England, recent work on the sort of historical coevolution of public and private insurance. And today he's going to be speaking about a very peculiar institution, not slavery, but this book. I don't know if you can see it. His most recent book called Delusions of Competence. I'll leave it to him to summarize the argument, but it certainly makes a very powerful and somewhat frightening case that Lloyd's of London, the famous insurance institution, was run by people who really had no idea what they were doing. And it is a great chance to get an inside look at a complex institution as it functions or doesn't function. And so we'll be treated to his analysis of that. And with that, I welcome Robin, and the stage is yours. Thank you.
Thanks, Pete. I'll share my screen, my PowerPoint, and hopefully it'll work. So can everyone see that okay? Is that okay? Sorry,
Yep, it works great.
Right, excellent. Okay. Well, first of all, I'd like to thank Travis and Pete for inviting me to join this present this webinar in your very important series. It's quite an honour. And the title of my book, or title of my presentation today, comes directly from my book that Pete was trying to show you in front of the screen. But I've very cannily, because I'm Scottish, I'm canny. I've cannily pasted the cover of the book on my opening slide. So there you have it, also with a URL link for if you want to read further on this, because obviously Lloyd's of London and it's the crisis that it entered in the 1970s, 1980s and 90s is a complex subject, and I can only really touch on some of the aspects of it today. Okay. So the problem that I addressed in my book and we want to address today is how do we explain the near death of Lloyd's of London, a 300-year-old, quite unique insurance market, the near death that occurred at the end of in the last 2 decades of the 20th century. Now, previous explanations have focused on the effects of catastrophe losses, long-tail liabilities like pollution and asbestos risks, which I'll come back to later on, fraud and scandals and poor governance. But my argument is that while these explanations are important, played an important role, multiple delusions of competence also played a critical role in bringing Lloyd's to the edge of extinction. And I think there's a bigger message from the story of Lloyd's in the 1970s through to the 1990s, in that it highlights the dangers that can be faced by complex financial systems from entrenched beliefs in the competence of experts and the efficacy of self-regulation. So I had planned actually to speak for about 35 to 40 minutes. So I apologize if I slip over Travis's 30-minute deadline, but I certainly hope to that things that I don't explain in this paper or in this presentation, please, I hope we'll have at least 20 minutes Q&A at the end, so people can ask me for explanations then if they wish. Also, because the audience is quite large and I'm quite diverse, I think. I'm aware that many people listening will be and watching will be experts in the insurance industry and insurance law, more expert than I am sure. But equally, there might be other students perhaps who are not familiar with Lloyd's and its history. So I think I do need to spend some time explaining the history of Lloyd's and its business practices and its structure and how it got itself into such a mess in the last quarter of the 20th century. So most people will know that from the 1680s, customers of Edward Lloyd's Coffee House in London transacted marine insurance for merchants and ship owners seeking insurance cover for their hulls and cargoes, mostly on overseas, as Britain's overseas trade grew in the late 17th century. And Lloyd's, from the 1680s, for the next 300 years, essentially, Lloyd's remained a market community of individual underwriters operating for themselves on an unlimited liability basis, with a governing committee that set some very general rules of behaviour in the market. But otherwise, it was a marketplace or a society, or the word that Lloyd's insiders love to use in our period, in the period I'm looking at, is a community of underwriters doing business for themselves under the auspices of the society's rules. It wasn't a business corporation, as many people mix it up or get confused about. It wasn't a business corporation. It didn't have capital. It didn't have owners, and it didn't have a board of directors. As I say, it was really a marketplace. In the late 19th century, Lloyd's began to diversify out of marine insurance, largely because of rising competition in the marine insurance market. It began to diversify out of marine into fire, earthquake, and a whole bunch of other insurance lines, which were relatively new for the 19th century. Insurance lines such as burglary, liability, indemnity, various forms of professional indemnity and liability insurance, and then later on aviation and motor insurance, and then further on in the 20th century it specialised also in providing insurance cover for the petrochemical industry, oil tankers, oil rigs, refineries and so on and so forth. And also catastrophe reinsurance became insurance and reinsurance became quite a substantial business. By the early 20th century, the membership of members at Lloyd's became known as names. Now, I've not been able to find any source that identifies exactly when this happened or why it happened. All we know is that in the legislation, the very few bits of statute laws that covered Lloyd's before the First World War, there's no mention of the word name referring to members of Lloyd's. This seems to have been a creation perhaps of the interwar period, but I can't be specific. But anyway, I'm going to call them names, the members of Lloyd's names in this presentation, because that's what they call themselves. And by the early 20th century, some names became detached from direct involvement in insurance operations. So you see a division appearing between what they called themselves working names, that is to say, those actively underwriting in the market, and non-working names, in other words, members who put up their own personal wealth as a kind of capital to underpin the insurance that was being done on their behalf, but they didn't actively underwrite themselves. So a fundamental division within the marketplace in Lloyd's between active working names and non-working names. Those actively underwriting, if you like, the professional underwriters, and if you like, the passive investors. Towards the end of the 19th century, names became organized into syndicates led by a working name. So you'd have relatively small syndicates consisting of one, perhaps two active underwriters, working names, insuring risks on behalf of the other non-working names in their syndicate. And syndicates in their early days were quite small in terms of size. In the 1880s, few syndicates had more than 6 names. But by the 1980s, 100 years later, we're looking at syndicates sometimes with more than 1,000 or several thousand members. And as syndicates became larger, they became administered by managing agents or managing agency firms who were responsible for appointing the active underwriters to syndicates, and in turn they received a fee and a commission on the syndicate's profits. So you've got names, working names, non-working names, and managing agents. Now, outsiders couldn't do business directly with Lloyd's. If you had a risk to insure, you couldn't simply walk into Lloyd's and insure it with whoever you pleased. You had to, you were required to hire a broker who was officially licensed by Lloyd's. And these brokers then would take their clients' orders for insurance into the marketplace and walk around the various underwriters' boxes of the different syndicates, trying to obtain the best prices and terms of insurance for their clients. And underwriters would specialize in different lines. So there'd be an area of the room which specialized in marine insurance, and there are other underwriters' boxes that specialized in fire and liability and indemnity insurance, etc., etc. And before and after the Second World War, brokers merged, leading to a greater market concentration. So by 1978, 68% of premiums earned at Lloyd's were being placed by just a dozen leading broking firms. And here's an particularly important point. Most of the managing agencies, as I said a moment ago, were responsible for appointing active underwriters. Most of the managing agencies became owned by a handful of giant broking firms by the 1970s. And so through their ownership of managing agencies, the brokers controlled most of the syndicates and therefore indirectly employed most of the underwriters. So you can see straight away an enormous potential for conflict of interest arising between brokers who theoretically were trying to seek the lowest premium rates for their clients, and underwriters whose job was to find the highest rates, seeking the best risks at the highest rates for the names on their syndicate. Despite its impressive capacity for product innovation and flexible underwriting in the 20th century, Lloyd's was widely regarded as an elitist old boys club with quite arcane rules and opaque practices that were pretty much invisible to the outside world. In one chapter of my book, an early chapter of my book, I've actually conducted an analysis, I think I'm right in saying the first kind of systematic analysis of a small sample of Lloyd's working members and leaders. And perhaps unsurprisingly, this analysis reveals a common background among these people. The vast majority, almost all of them, attended what we call in Britain public school. That means elite, high fee paying private schools. Schools like Eton or Harrow or Winchester. People Lloyd's working members either entered Lloyd's directly from school, from these public schools at the age of 16 or so, or some of them went on to, particularly the younger ones, entering Lloyd's from the 1950s onwards, tended to then go from public school to Oxford or Cambridge, and then enter Lloyd's directly from there. I also found quite a lot of working members who had some military experience, especially those entering Lloyd's in the 1950s, had usually either served in the armed forces during the Second World War or served under national service, it's called, which is universal conscription, that carried on in Britain for several years after the Second World War. Most of them had family homes in London and or the rural home counties surrounding London, so very much geographically concentrated in the southeast of England. And most of them pursued country leisure activities such as shooting, fishing, hunting, and also music, opera, skiing, sailing, golf. In other words, these were wealthy people who shared the leisure activities characteristic of their upper social class. And this common culture generated conservative modes of thought and contributed to what I would call Lloyd's fundamental belief system that you can quite easily trace in the records of Lloyd's in the 1970s and 1980s. This belief system consisted in four fundamental beliefs. One, a belief in the sacrosanct freedom of the market in the room, as it was called. The underwriting room at Lloyd's was known as the room, colloquially. Secondly, they held the belief that the efficiency, flexibility and innovation of Lloyd's were best maintained by leaving underwriters and brokers alone to conduct insurance as they saw fit without outside interference, either by the governing committee of Lloyd's or by outside forces. Thirdly, a third fundamental belief was that competence was gained by hands-on experience at the underwriter's box, junior underwriters learning from senior underwriters, clerks or junior entry clerks learning from junior underwriters, and so on and so forth, through that hierarchy, rather than by formal education delivered outside the marketplace or outside Lloyd's. And fourthly, most of them held the belief that the right of self-regulation and Lloyd's global reputation were best preserved by ensuring that as far as possible Lloyd's remained a secretive place of ancient practices. Someone called it a stuffy place, somewhat separate from the rest of the city of London, the other financial institutions in London. There's a nice quote by a chap called Francis Halford, who worked at Lloyd's in the 1950s, and one of his first jobs was in the Lloyd's information department. And in an interview in the early 1990s, he declared that the mission of Lloyd's information department was to give out as little information as possible, which I thought was quite nice and probably to the point as well. Anyway, after the Second World War, the Lloyd's grew very rapidly, particularly on the back of reinsuring property and casualty risks in the United States. So by the mid-1960s, at the time of Hurricane Betsy, US property and casualty risks, reinsurance, I should say, generated about half of all of Lloyd's business. Hurricane Betsy, which there's a map of it on the slide here, which hit crossed the Gulf of Mexico in 1965, marked the beginning and led to very large losses among Lloyd's syndicates, reinsuring properties in that area in the United States. It led to 3 consecutive years of losses and 5 years of declining capacity as names exited the market, faced with the rising costs on their syndicate accounts. And this quite quickly made Lloyd's committee aware of an urgent need to raise underwriting capacity by increasing its membership. So it commissioned a report in 1969 by Earl Cromer, who, when he reported, he recommended lowering entry barriers to membership and opening up Lloyd's to foreigners and to women. No women were admitted at all in Lloyd's in any capacity before 1970. But from 1970 onwards, as the Cromer recommendations are implemented, you see women entering as brokers, as administrative staff, and also Canadians and Americans in particular began to constitute a rising proportion, albeit still a small proportion, 10% or so, of the total Lloyd's membership. The growth of the Cromer report and the lowering of thresholds led to quite rapid growth in the membership of Lloyd's, which you can see on this graph. Within 10 years, from 1970 to 1980, membership of Lloyd's more than tripled from about 6,000 members in 1970 to almost 19,000 by 1980. And these new members were not only attracted by the lower financial thresholds for entry, but also and by the years of sustained profits in the early 1970s that Lloyd's enjoyed, but also by tax advantages associated with membership. I can explain the tax, how Lloyd's profits were taxed, income from their syndicate profits in Lloyd's were taxed. But essentially the point is that they were taxed at a much lower rate, capital gains rate, than personal income tax. Personal income tax in Britain in the 1970s for high earners reached this quite staggering figure of 98% in the late 1970s. So there were these major tax advantages were a major attraction for people joining Lloyd's. Okay, so while new members flooded into Lloyd's in the 1970s, the market began to suffer, especially from the late 70s onwards, an unprecedented series of tanker, oil rig and aviation disasters, and also the first of a quite staggering series of scandals. Unfortunately, in the time I've got today, I would love to tell you lots of stories of the scandals at Lloyd's in the 1980s, but I don't have really the time to go into the details of all of them. But I will talk about two. One at this juncture, and then I'll talk about a problem with one syndicate in the reinsurance sector later on in the presentation. So the most prominent scandal in the late 1970s was affected a syndicate run by a managing agency firm called Sasse-Turnbull and Company. The chief underwriter of the syndicate was a chap called Tim Sasse, S-A-S-S-E. And in 1975, he authorized a Florida-based firm run by a character called Dennis Harrison, someone who later turned out to have, or at least is alleged to have, mafia links. He authorized Harrison's firm to insure on behalf of Sasse's syndicate North American risks in the United States and Canada. However, Sasse failed to check the reputation of Harrison's firm or the individual concerned or the business that it was doing. Harrison promptly went out and insured derelict properties in the South Bronx slums, many of which burnt down within a few months of them being insured, at a cost to the syndicate of about $25 million. A couple of years later, when these losses were becoming more and more evident, over 40 of the names on the Sasse syndicate refused to pay the calls on their deposits to pay these claims from the South Bronx, and the syndicate was suspended. Moreover, the names on the Sasse syndicate formed an action group, and 3 years later they sued Lloyd's for a failure of supervision. Eventually an out-of-court settlement was reached, in which, importantly, Lloyd's shouldered 2/3 of the losses, which is the first breach of the principle that I've come across of the principle of the unlimited liability of names for all losses that their syndicates incurred. So the Sasse-Turnbull affair by itself was relatively small, £25 million losses, not on the scale of some of the losses that occurred later in the 1980s. But nevertheless, it was it's important because it was an early manifestation of two phenomena that repeatedly dogged Lloyd's more and more during the course of the following decade. Firstly, the way Sasse names formed action groups, that issued lawsuits against their underwriters and managing agents for negligent or incompetent underwriting, and then also went on to sue Lloyd's for poor supervision of the market. And secondly, the way that pressure from losses and large numbers of defaulting names pushed Lloyd's, in this instance, reluctantly into ever greater acts of intervention to bail out names, to sustain the reputation of the market, and to try and protect the principle of self-governance from those who were calling for a greater external scrutiny of Lloyd's practices. So you can see trends happening in the aftermath of the Sasse-Turnbull affair that become more and more prominent during the 1980s. In 1982, Lloyd's obtained a new Act of Parliament to replace its original one of 1871. By this stage, Lloyd's had more than 20,000 members when its original Act of Parliament back in 1871, it only had about less than 400 members. So you can see the argument for one of the arguments for a new Act of Parliament was that the old Victorian Act of Parliament really wasn't fit for purpose for such an entirely much bigger institution. At the insistence, so the Act of Parliament did two things importantly. It replaced the old Lloyd's Committee with a new and larger Lloyd's Council as the supreme governing body of Lloyd's, with greater representation of non-working names, although they still were not a majority. Still, the working members of Lloyd's, the working names at Lloyd's, who represented about 15% of the total membership, occupied a majority of seats on the Lloyd's Council right through the 1980s. And it gave the Lloyd's Council greater disciplinary powers over the members of Lloyd's. Secondly, the Act of 1982 forced Lloyd's brokers to sell off their underwriting interests in managing agency firms, and that eventually helped resolve that particular conflict of interests between brokers controlling, having a vested interest in underwriting, in underwriters. However, the Act did not threaten in any way the core principle of self-regulation. At the insistence of the Bank of England, Ian Hay-Davidson, who's pictured here and whose book's also on this slide, which he wrote shortly after he resigned his position at Lloyd's. Ian Hay-Davidson was appointed as the first salaried CEO Lloyd's ever had. He had previously been chairman of the Accounting Standards Committee and was a fraud investigator for the Department of Trade and Industry. So he came into Lloyd's envisaging his role as CEO as one of a troubleshooter tasked with developing better accounting rules, better auditing rules, rooting out fraud and restoring Lloyd's public reputation. But before the Lloyd's Act came into force in January 1983, a new generation, if you like, or wave of scandals hit the market. And most of these scandals, as I say, unfortunately, I haven't got time to go through some of the details of them, such as the Alexander Howden agency scandal. Most of them involved the fraudulent use of syndicate money by underwriters and by directors of broking firms that were interested in particular syndicates. And this new generation of scandals was on a larger scale than the Sasse-Turnbull affair that I described earlier. It involved larger numbers of names because all this time syndicates were growing in size. And it also generated much more publicity, bad publicity, of course, in the media for Lloyd's. Despite the bad publicity, the tax advantages continued to function, and the Lloyd's continued to be in profit. I think I can show this on a. I'll just get to the slide. There's the profit. So Lloyd's through the mid 1980s, at least to 1988, still remained in profit. I will come back to this slide in a moment or later on. Lloyd's continued be in profit and continue to offer tax advantages. So therefore, names continue to flood into Lloyd's, so that Lloyd's reached a peak of membership of 32,000 members by 1988, which is the year that this mountain of membership begins to tail off, as you can see. I'll come back to that in a moment. As well as public stories about scandals at Lloyd's in 1985, which concerned the public and politicians. In 1985, November 1985, Ian Hay Davidson decided to resign. He'd had enough. He'd been there 3 years. He tried to exercise his role as a troubleshooter. He tried to introduce auditing and accounting reforms as best he could, but he constantly came up against barriers on Lloyd's Council. Particularly, he had a very bad relationship with Peter Miller, who was his contemporary as chair of council. Miller wanted to rein in Davidson. Davidson wanted more powers. And eventually Davidson had enough, wrote a resignation letter, which was published in the Times. And this, together with the scandals, began to lead to more and more questions being raised in the British Parliament about what was going on in Lloyd's. In 1986, during the debates on the Financial Services Bill, which was an act of Parliament designed to set up a new financial services authority, a regulatory body for the City of London, Labour MPs denounced Lloyd's as a school for scandals, echoing Richard Sheridan's play of the 1770s, also known as titled A School for Scandals. And Labour demanded that Lloyd's be included in the bill, be included under the auspices of the new Financial Services Authority. The Thatcher government rejected this, although it did appoint an inquiry chaired by the Chancellor of Oxford University, Sir Patrick Neill, into Lloyd's governance. And the Neill Committee reported in 1987 recommending an increasing representation of non-working names on Lloyd's Council, but this proved to be no solution to the tidal wave of losses of claims that were about to crash heavily over Lloyd's market from 1988 onwards. The scandals of the early 1980s centred on the fraudulent use of syndicate funds. A larger, more damaging category of scandal that emerged from the mid-1980s concerned negligent or incompetent underwriting, especially of excess of loss reinsurance. Now, I do have a slide that kind of demonstrates how excess of loss worked, but again, because of time constraints, I'm going to skip this slide, but I'm very happy to describe it, work through it for you if anybody's unsure about what essentially it's where reinsurers agree to insure to reinsure a risk above a claim on a risk above a certain amount of loss. So hence the word excess loss, and the amount is written into the reinsurance contracts between the insurer and the reinsurer. One of the highest profile excess loss cases was that of the syndicate run by Richard Outhwaite. And I mention this particular case because it's typical of some of the other cases that appeared in the late 1980s in this particular market of Lloyd's for excess loss reinsurance, typical of some of the problems that were generated by this, that you could find in this particular market. Now, in 1982, Richard Outhwaite, who had written off 31 run-off contracts that reinsured other syndicates against the risk of asbestos claims in the United States. Now, some of these asbestos risks that were reinsured by Outhwaite on behalf of the syndicate in 1982, some of the original policies in the US dated back to the 1940s. It was alleged later at the trial in a lawsuit brought by Outhwaite's syndicate's names that Outhwaite, who was quite a successful marine underwriter, and knew virtually nothing about this area of insurance. He'd entered the market, the XL market, the excess loss market, pretty blind. The premiums he charged for his reinsurance were too low. He'd failed to take into account the huge surge in asbestos-related injury claims in the United States at the very time he was writing the policies. By the end of the 1980s, US asbestosis claims alone were estimated at $100 billion. Lloyd's investigated. Outhwaite's names protested about the losses coming in on these contracts. Lloyd's counsel investigated. They couldn't find any evidence of fraudulent underwriting, and they refused to take any further action. They claimed that they weren't responsible for the competence of the underwriters in Lloyd's, and therefore they weren't liable to the to the names on syndicates and Lloyd's. And yet the claims continue to roll in on Outhwaite's 1982 account, so it couldn't be closed. Eventually, it was estimated that the shortfall in the Outhwaite names accounts was over £20,000 for every £10,000 they put up as a deposit in their syndicate. So the money they were losing was twice as much as the money that they'd invested in the syndicate. In 1981, nearly 1,000 names sued the managing agencies of the Outhwaite syndicate for his reckless underwriting that had led to losses of £260 million. And at the time, this is the largest legal action yet seen at Lloyd's. The trial lasted 4 months, and at the end of that, the names settled out of court. It was important because Outhwaite acted as a test case for many other suits against other syndicates. By 1991, it was estimated that 20% of all members at Lloyd's, of all names at Lloyd's, had organised themselves into action groups to sue their syndicates for losses due to poor underwriting and to pursue Lloyd's for compensation because of supervisory failures. By the late 1980s then, Lloyd's was circling the wagons. It was mounting an increasingly desperate defence against external demands for further reforms to its governance and business practices. 3 factors pushed Lloyd's at this point into beginning to make a series of fundamental reforms. Firstly, the onset of 5 consecutive years of record losses that you can see there, from 1988 to 1992. Secondly, the growing scale of litigation by discontented names facing large bills for claims on their syndicates. And thirdly, also importantly, I think, the withdrawal of support for the principle of regulation by large sections of the British media and the British Parliament. You can see this in the debates around the Financial Services Bill of 1986. You can see the way, first of all, the Labour frontbench moves from its position that it had adopted in the late 1970s of allowing Lloyd's to self-govern itself and believing all the messages that Lloyd's were spewing out about what a great institution it was and how it was honest and there's no problems. But by the mid-1980s, their position has changed, and they really began, the Labour frontbench, the opposition frontbench, began to think that an independent regulator was necessary. And even some conservative backbenchers on the government side, began to think that regulation of Lloyd's independent regulation of Lloyd's was necessary. So there was a clear political shift through the mid-1980s away from supporting Lloyd's right to self-regulation and towards independent supervision. The reforms that Lloyd's introduced included the tightening, I haven't got time to go into details, but included tightening supervision of business practices, detaching outstanding liabilities from syndicates in trouble and wrapping them up and running them through a new specialist reinsurance vehicle called Equitas. And finally, in 1994, admitting corporate members for the first time in Lloyd's history with limited liability. And these measures together enabled Lloyd's to survive, albeit in an entirely restructured form. The old boys club disappeared remarkably quickly. Individual names fell from the 32,000 peak in 1988 to just 773 individual names by 2010, and I think nowadays there's really very few. By 2014, corporate members at Lloyd's accounted for 98% of Lloyd's underwriting capacity, so it had virtually been taken over by corporate capital as opposed to individual capital. In 1998, the new Labour government of Tony Blair announced that Lloyd's would be independently regulated by the Financial Services Authority, which was a reversal of the Conservative government's decision of 1986. And after further heavy losses surrounding the 9/11 tragedy in the United States, Lloyd's entered a period after being hit heavily by losses from relating to the World Trade Center and other disasters at the time. Lloyd's then began to enter a sustained period of profitability. There's just 2 loss-making years between 2002 and 2016. Okay, so how do we explain the crisis? Now, several factors brought Lloyd's to a tipping point at the end of the 1980s. The inexperienced names entering the market exhibited, you could argue they exhibited signs of contagious behavior, the search for easy money, the lure of being a member of an elitist and quite sort of aristocratic club. Features that were characteristic really of a regular financial speculative bubble. Then, of course, you have the wave of catastrophe and liability losses that were far in excess of the normal underwriting cycle. There were tax changes in the mid-1980s where the British Inland Revenue caught up with Lloyd's and changed the tax codes so that Lloyd's members started paying personal income tax on their profits from Lloyd's, and that bumped up the tax burden by about 30 to 35% on individual names, making, of course, membership less attractive. And then, of course, there were the scandals, the ongoing scandals and frauds as well. All these factors made Lloyd's less attractive to unlimited liability individual investors by the early 1990s. And this is my final slide, so if you're worrying about time running on, I'm nearly finished. However, I would also argue that a belief in the traditional ways of doing things also compounded the crisis at Lloyd's. An inflated confidence in their own abilities led underwriters into the excess loss business, a market that many didn't, like Richard Outhwaite, didn't understand and whose risks they didn't know how to price. Writing excess loss risks required an expert consideration of rating and exposure. Setting premiums based on tacit knowledge or know-how or gut feeling simply wouldn't do in a world of rapid technological and environmental change, much of it, of course, associated with accelerating climate change and unprecedented losses from natural catastrophes and long-term liabilities. The problem, I would argue, is that the institutional environment at Lloyd's and the lack of professional education among underwriters constrained the ability of scientific knowledge and rational analysis to feed into and inform tacit knowledge and to reshape the business practices in the room. Modern studies have shown that the success of intuitive decision-making depends greatly on the predictability of the environment in which decisions are made. It can deliver profits in staple markets such as marine and aviation insurance, where risks are usually discrete, one airplane, one ship, and fairly well known. But intuition can lead underwriters, or could lead underwriters, to underinsure against low probability, high loss events, or to avoid seeking out additional information when confronted with adverse news, the latest hurricane, the latest volcano, etc. And this kind of resembles the ostrich effect that's been observed with professional investors. Howard Kunreuter and his colleagues have argued, Howard Kunreuter used to be at the Wharton School, I'm not sure where he is now, have argued that rich context information is necessary for insurers to be able to price risks accurately, where there is ambiguity about event probability or where there is uncertainty about the scale of possible losses. The information systems and deal-making practices employed at Lloyd's didn't lend themselves to the acquisition and analysis of such risk-rich contexts. There was a nice quotation by, I don't want to give you the wrong quotation, so let me just dig it up. Sorry, I do apologize. 2 seconds. Okay, there's a nice story about a Munich Re underwriter who was telling an audience in London in the early 2000s, with only possibly a little exaggeration, and obviously quite proudly, that, quote, "We Germans use technical rates. In London, they use ceiling rates. The underwriter reads the slip, looks at the ceiling, and puts down the first number which comes into his head." Now, a belief among underwriters in the superiority of their knowledge appears, especially in the excess loss market, to have led to overconfidence and cognitive dissonance and inability to know the limits of one's expertise. Overconfidence in turn may have led to tunneling, the instinct to make inferences too quickly and to focus on a small number of known sources of uncertainty, to herding, the desire to avoid being an outlier in one's predictions, which has been widely observed of financial forecasters, and to confirmation bias, whereby experts try to interpret evidence with the aim of corroborating the rules that they'd already made up. The practice at Lloyd's of syndicate underwriters following the premium rates set by a recognised lead underwriter, and I can explain this a little bit more later if you want me to, would have reinforced these behavioural traits. The combined effect of these behaviours on excess loss underwriting would have been a heightened tendency to ignore black swans, the unknown or unimagined events that can deliver catastrophic losses, and there's obvious parallels with the behaviour of investors in the market for subprime mortgage default risk that led to the global financial collapse of 2007-2008. So to sum up, by 1988, no amount of internal governance and accounting reform could have saved Lloyd's from collapse. Fundamental flaws lay buried in the market's closed structure. Its outdated practices proved vulnerable to the cataclysmic losses which arose in the 1980s and 1990s. These core weaknesses, however, were nurtured and exaggerated, if you like, or heightened by multiple delusions of confidence. The faith of underwriters and brokers in their own know-how, the belief of politicians, successive governments and Lloyd's insiders in Lloyd's ability to govern and regulate itself, and the trust placed by names and policyholders and indeed the general public at large in Lloyd's and its insider experts. This combination of external and internal delusions of competence reinforced each other and helped drive this historic financial institution to the brink of extinction. Thanks.
All right, thank you. So I'll keep a queue. If you'd like to be on the queue, just raise your hand using the WebEx function or send me a chat. And the first person on the queue is Peter Siegelman.
Wonderful. Thank you, Travis. Thanks for that really fascinating talk. I had the advantage of reading the book. There's a lot more richness and much more detail that obviously you just couldn't possibly package in that short amount of time. So my way into the question I want to ask is to start by what I think is a true observation about the book. I did not see the word actuary once, and I looked in the index, it wasn't there. Were they really doing all of this underwriting without anybody who did sort of the most basic kind of math statistics about measuring risk? And if so, how is anybody, so the first part of the question is, how is anybody outside ever willing to put their money into an institution where it was just all seat of the pants? I'm just really puzzled by that fact. And then I guess the follow-on question would be, how do we, so looking backwards, you are in a great position to critique the obvious, as you say, the delusions of competence. These people just didn't know what they were doing, and the results speak for themselves. But in real time, this had been around for a long time, this institution. It seemed for a while to be doing very well. How are we supposed to be able to judge the lack of expertise of these people who are the only people with the real information? And especially if there's no actuaries and nothing's being measured, like what possible checks could there be? How would regulators, if there were regulators, even know that there was a problem there, at least until a problem started to sort of stockpile? So if you could speak to that, I'd be very interested in hearing your answer.
Sure. Well, technically, actuaries were pretty irrelevant to Lloyd's because they did almost no life insurance. So that's just like off the by. But your general point about actuarial type risk assessment, scientific risk assessment, is a good one, I think. It seems to be that specialist underwriters at Lloyd's, those who specialise in particular lines of insurance, built up a knowledge of the kinds of risks they were insuring. They did refer to some data of historic losses in particular lines like oil tankers or oil rigs, etc., etc. But there was no, as far as I'm aware, there was no kind of examples at Lloyd's of the kind of computer modelling of catastrophe risk, for example, that's you're beginning to see in the 1980s and 1990s in big, multinational insurance companies such as Swiss Re or particularly Munich Re. the fact that the other point about the profitability at Lloyd's is that one mustn't exaggerate about Lloyd's. There were about 400 syndicates operating in Lloyd's by the end of the 1980s. About 80 to 90 of those did excess loss reinsurance. 60%, however, so less than a quarter of the syndicates at Lloyd's were involved in excess loss reinsurance. However, 60% of the losses that Lloyd's faced by the end of the 1980s came from that particular market, that particular business. And the problem was that in other lines of insurance, when the underwriting cycle dived down, fell away, demand fell, prices fell, there was a rush by underwriters from other markets into the people like Richard Outhwaite, left their areas of specialist expertise and launched themselves into excess loss reinsurance, a market about which they didn't really know. I mean, the point about quoting the guy from Munich Re is that these European reinsurance firms, specialized in this kind of business, realized that they had to worked on this sort of probable PML, probable maximum loss calculation. What is the biggest loss that could possibly happen if we reinsurance property in Florida, a certain amount of property in a particular area of Florida? There was no calculations like that were ever made at Lloyd's. Probably because the underwriters didn't either see the need or understand the market. Now, as far as people entering the market is concerned, one of the points I was trying to make earlier in the presentation was that there was this big rush, this trebling of membership of Lloyd's in the 1970s. A lot of people were coming into Lloyd's because the entry threshold had fallen, and because the profits were taxed at a very low rate. They could, they saw Lloyd's as a sort of a gift that kept on giving, really, or something to, an opportunity to make money that was too good to miss. And there was also a lot of mystique about Lloyd's, about joining. Lloyd presented itself to new members as a kind of an elitist, club, which whose practices you didn't question. You simply joined a syndicate. You put your house up as the value of your house up, or your car up as a deposit, and you sat back and hoped that the money would come, the profits would come in from the syndicate that you joined. There was very little, and this was a constant debate in Lloyd's in the complaints by names during the 1980s. Barely a trickle of information filtered down from the people doing the underwriting to the names on their syndicates. It was really remarkable, really, when you think of, from an investor's point of view, these people were investing in something that really knew nothing about. And there's many quotations from people who lost their houses or their retirement pensions, having invested in Lloyd's syndicate and lost their money. Many quotations that describe this feeling of being, sort of having had the wool pulled over their eyes. I'm not sure if I have answered all your questions, Pete, or kind of, yeah.
Get to the next one.
Exactly.
And I'm sure we'll be able to circle back. Jackie Bashaw.
Yes, thank you for presenting to us. I also have a two-part question. The first one was what prompted you to look at this crisis in the first place and to reanalyze the source of Lloyd's issues from the start. And then as you went about that, I was interested about the delusions of competence in chapter 1, and that are also conveniently on the screen right now. How did you prevent your own biases or tunneling, or now that you learned about these issues, how did you prevent them from infiltrating your own research?
Yeah, well, that second question is a very, very, very good one. The first question is easier to answer. Basically, it goes back to a seminar run by a financial historian called Ranald Meekie, who had picked up Malcolm Gladwell's idea of the tipping point, and this was in 2011, so not long after the mortgage default crisis, and he was interested in the way financial systems could could suffer problems that accumulated until they hit a tipping point, and then the system would collapse. And he invited me to give a paper, and I kind of scratched my head really, thinking of, apart from AIG, which obviously had a federal bailout in the 2008 crash, it tended to be banks that, sort of the contagion effect operated in, tipping points operated in. And then I thought of Lloyd's, and I thought Lloyd's was really the only example I could think of in insurance history where an entire market suffered this accumulation of problems till it reached that tipping point in 1988, where it tipped over into record-breaking losses and then near collapse. So that was kind of my reason for investigating this a little bit further. The ideas of delusions of competence came to me quite late, really. It was after I'd done much of the work on the original paper, and the more I read into, and I got permission from Lloyd's to look at their internal records. So I did a lot of work on, if you look at the book, you'll see that I've done a fair bit of work on Lloyd's internal records, as much as they survive, of the governing council and debates in internal debates in Lloyd's. Material that wasn't produced, documents that weren't produced for publication or for public consumption. And it was as I was reading those Lloyd's internal records that I began to see connections between the literature that I'd read on economic psychology and behavioral economics, and then I discovered this large literature on expertise in the critiques of, not just in finance, but there's a huge library of literature now on experts in medicine, and and I mean the COVID outbreak is a classic example of public concerns about the interface between expert advice and public policy, and this seemed to be a nice example from insurance where the claims of expertise by Lloyd's insiders, Lloyd's underwriters, seem to be unraveling as these lawsuits passed through court, and as external judges took a kind of a legal eye on what had been happening in these cases. And some of the judges came out in their rulings, came out with quite damning verdicts on the competence of the underwriters that they were asked to judge about. So I'm hoping that my own interest in economic psychology hasn't kind of over burdened the story or distorted the story. But I would say that the real crisis in the, as I said to Pete, the real crisis in the excess, it's not that Lloyd's was a total catastrophe, in the sense that there were many parts of the market, aviation insurance, marine insurance, that still worked reasonably well throughout this period. It's just that the huge scale of losses in these very large syndicates that were underwriting this excess catastrophe loss reinsurance, industrial pollution risks, asbestos risks, sort of long tail liabilities, these losses just kind of overwhelmed, and the lawsuits that followed and the defaults by names, not paying claims, just kind of really, helped break the system, really.
So we have 1 minute left. I mean, Robin, would you be interested in sticking around for another 5 minutes, 10 minutes or so?
Sure, no problem. I'm not going to bed yet. It is quite late here.
Well, I mean, the queue is open. I might allow myself to ask one question. I know a little bit about the history of insurance, and it seems like at each point when you have real innovations on the product side, new lines of insurance getting created, it happens when you have often some guy with the delusion of competence, who's willing to take the chance and with no statistical knowledge backing up, his business risk to underwrite a new type of risk. And then he often fails, and people come after him and produce a market that it rests on sounder foundations, and we end up with insurance that we didn't have before, which seems like a good thing. And so, I mean, the question for you is, were there positive effects of this delusion of competence from Lloyd's? And it's because it seems like there were, they were selling new types of insurance that others weren't. And if so, whether you think that either the kind of old boy nature of the institution and or the concentration of wealth that it represented gave it a unique position to innovate on the product side, or not.
Yeah, no, I think those are good points, actually. There is the general literature on expertise is that these issues of competence that I've been describing for Lloyd's affected people's ability to judge their own, generated cognitive dissonance, affected their ability to judge their own expertise. And that essentially was a negative thing for financial markets, a negative thing in the case of Lloyd's. I have come across one article, though, that did a quantitative analysis, plyometric analysis of investors in the equity market. I think I'm not quite sure which market it was in London, but the argument there was a fairly recent article. I'm sorry, I can't give you the details, but they argued that a lack of expertise of and an almost an unacceptable level of risk taking by investors in this particular market actually encouraged innovation, was a good thing. And if you go back to the grand old man of product innovation at Lloyd's, which was a broker called Cuthbert Heath, I'm going back to the 1870s and 1880s. Cuthbert Heath was the guy who almost single-handedly dragged Lloyd's out of marine insurance into all these other newfangled forms of insurance from the 1880s through to the First World War. Cuthbert Heath was well-heeled, as most Lloyd's underwriters were and brokers were in this period. Came from a wealthy upper middle class background, so he had a lot of personal wealth. Someone came to him one day and said, I know you guys only do marine insurance, but would you be interested in insuring my property against fire? And Cuthbert Heath said, why not? And then other people came to him, asked him to write burglary insurance and jewelry, the insurance of jewelry and old masters' paintings. He started this on a very small scale. So he obviously was able to assess the risk in terms of the character of the client bringing him the insurance and the circumstances of the risk. So it was all done on a fairly small scale to begin with. And then Cuthbert Heath did something else that was novel for Lloyd's in the late 19th century, and that was introduce an audit of the members of his syndicate's assets. So he was the first to introduce some kind of measure of the wealth being brought into his syndicate, and to match that wealth with the amount of underwriting he was going to do. So there were a number of innovations, and this was all done, as you say, without necessarily any training in these new lines of insurance or any substantive statistical basis for this. But of course, if you enter new lines of insurance in the late 20th century on a big scale, like the catastrophe reinsurance business, then it's a different ballgame, because one mistake can cost you millions of dollars. Whereas one mistake for Cuthbert Heath back in the 1880s on burglary insurance might have cost him half a year's revenue, but it wasn't going to bring down his syndicate. So I think, I'm not sure if that helps answer your question, but I think a lack of expertise can. I'm open to the argument that a lack of competence, a lack of expertise, can generate innovation and entrepreneurial activity in particular markets. But when it's done on a big scale, as we saw in Lloyd's in the late 1980s, it can be catastrophic.
Well, great, thank you. On behalf of everyone, I'm sure I'd like to thank you for a fascinating presentation, for joining us, and for kicking off our workshop series this semester. Thanks a ton.
Okay, great. Nice to be with you all. Bye.